Crypto has created trillions of value, and it has also vaporized it. The man that sits in front of me today had a front row seat to both. You are one of the Middle East's most active Web3 investors.
This space has not even started yet. When you talk about Web3 VCs, people are raising $5 million. I don't think that is what venture capital is all about. Unfortunately, no one understands crypto till now. No one understands what Bitcoin is. In old times, when two kings used to fight, the losing king would take his gold and run away. Gold was portable. Today, when you have Gaza or when you have Ukraine, can you run away with your dollars or gold? No. You remember 12 words, and that is your Bitcoin wallet. Today, close to 500 million wallets exist. Today, if you look at Solana, the number of active wallets and the number of users on board is phenomenal. These companies have adoption, these companies have revenue, and they're growing. What they really need to do is they have to step out from their crypto bro community and get real people on board. A lot of mines are there in Africa. We can tokenize those mines. People can get access to capital. Not just promoting yourself in Singapore and New York at events, having parties, but getting real people who are not speculating on your tokens, but using your tokens to do something.
There's a lot of Web3 founders out there that say we have a great tokenomics. What are the real sort of KPIs that you're looking at to see that their tokens have high utility? Hey founders, ready to match with your next investor? At lucidityinsights.com, we've built the Middle East's first Tinder for startup founders and VCs. Explore 800 verified VC and angel profiles, see who they're funding, and send your pitch deck directly, all in one place. Stop waiting for introductions. Make your own luck at lucidityinsights.com. And for a limited time, get 20% off your startup registration with the code TPP20 at checkout. Crypto has created trillions of value, and it has also vaporized it. The man that sits in front of me today had a front row seat to both. He's been through the collapse of Luna and the implosion of FTX and the rise of Dubai as a Web3 hub. Today, we're unpacking what separates real infrastructure from speculation and what founders still fundamentally misunderstand about raising in the Web3 space. Vineet Budki, CEO and managing partner of Sigma Capital, you are one of the Middle East's most active Web3 investors. I think you've invested in Sui, Berachain, Say, and Miston Labs, among 300 plus other blockchains. I welcome you to the show.
Great to be here, Erica. And Miston Labs and Sui are the same, but yes, 300 plus investments in this space.
Well, that already tells you what kind of novice I am in this space. And I think I've already given you that intro. And so I think we're going to have a really great conversation because I want to dive really deep, but I also don't want to miss the fundamentals because, as you already know, I'm a little bit still slightly skeptical of the Web3 space.
And before the chat, you said you have sort of moved out of Web3. We'll get you back in Web3 now.
Let's see. You've got an hour to convince me.
Sure.
So, Vineet, you've described your new investment firm, Sigma Capital, as becoming the Sequoia or SoftBank of the crypto market. That's a pretty big and bold claim. I want you to tell me why you have the right to say that.
So again, for me, I think this space has not even started yet. When you talk about Web3 VCs, people are raising $5 million. I don't think that is what venture capital is all about. Uber didn't raise $1 billion to make a flashy app. They raised $1 billion to get millions of people to use their app. So I don't think that real venture capital has come over here. I see myself to be an early mover in this space. I've delivered on my last two funds. The first one did a good 50x on the all-time high. The second one was a 6x as well. Cypher Capital, everyone in the Middle East knows about Cypher Capital. So I think, when it comes to performance, that has been there. But what I look at it is how do we see to it that we end up getting family offices and traditional capital into this space, make them understand what crypto actually means, because unfortunately no one understands crypto till now. No one understands what Bitcoin is.
So let's start there. Because you asked me, why did you get out? What are you investing in as when you invest in crypto? And I kind of looked at you and I said, well, I think if we want to get specific about it, I'm investing in a token that's supposed to have some sort of utilitarian process, or I'm investing in a technology that I really believe in. What say you? What is crypto? What is it that we don't understand?
So again, when you look at investing as a venture capitalist, you either invest in equity, and equity always means ownership of future revenue. Binance today, suppose it does $100 million of revenue, the dividend goes to CZ because he's the owner of Binance. But when you're investing in token of a company, you're investing in the process of that company. Binance, the core underlying activity of Binance is to trade tokens, and the trading fee goes in Binance as a coin. So if suppose trading today, you do $1 billion of volume, tomorrow you do $100 billion of volume, the token will be needed more, and price appreciation comes from there. So technically, tokens is nothing else but usage buying of process. Ethereum is a smart contract platform. Like a vending machine has $1 you put in and you get a Pepsi. That's a smart contract driven process. Tomorrow, when millions of transactions will be done on either, say, Ethereum or Sui, the token will be needed more and the token price will go up. When you look at WorldCoin, which basically digitizes your identity, something like in India where Aadhaar card basically takes your biometrics and makes it into a card and a bank account, WorldCoin does the same thing. If tomorrow people start using WorldCoin ID a lot, the process will be driven on a coin. So token or coin is nothing but ownership of process. When the company processes become very big, the token will appreciate in prices. Unfortunately, globally, not just, people say, oh, this is a global south problem or the Dubai problem. Everywhere in the world, people don't understand any of these tokens. When I ask them what does Ripple do, or when I ask them what does Ethereum do, or even what Bitcoin does. In fact, this is a question to me. What is Bitcoin to you?
To me, Bitcoin is just a very mystical digital form of gold.
Okay.
It feels like a commodity that is rare and is intriguing. Obviously, there's also this mission-driven layer on it that it's supposed to be decentralized and whatever, but I don't really see a utilitarian purpose to it.
Okay, so for me, I divide crypto in 4 or 5 different categories, and when I come to Bitcoin, when I talk about, say, buying a house in New York, or when I talk about buying gold, or when I talk about buying Picasso's painting, the commonality of these 3 things is that they store value. Anything that stores value is known as an asset. And when I ask people what is the basis of an asset, they say it is rarity. You don't buy titanium or you don't buy platinum. They're more rare than gold. A house in Dubai is equivalent to a house in Uganda. Why don't you buy it in Uganda? So assets are formed on perception. Your mom told you to buy gold and your dad told you to buy probably a house in Toronto. The perception angle remains. Now with Bitcoin, the utility is a store of value because the perception in the global south, not in New York or not in Singapore, but in global south where people cannot save their money, the perception is that Bitcoin is a store of value. Latin America, Argentina, the peso has depreciated 95% in 10 years. Zimbabwe, inflation is crazy. Lebanon, you cannot get your money out. Turkey, the currency has depreciated. How does the person store his value? This is where Bitcoin's core utility of store of value comes. Second utility is, if you have $1 million house in Dubai and you don't have a job or you don't have a steady source of income, the bank will not give you a loan. But if you have $1 million of Bitcoin, go to Aave tomorrow morning and you will get a 75% loan. So store of value, bankable, and the most important thing, in old times, when 2 kings used to fight, the losing king would take his gold and run away. Gold was portable because he would make an army and come back. Today, when you have Gaza or when you have Ukraine, can you run away with your dollars or gold? No. You remember 12 words and that is your Bitcoin wallet. So Bitcoin has portability. So when you look at these 3 things, store of value, portability and bankability, and understand that today close to 500 million wallets exist, which means, if I assume 1 person, 1 wallet, less than 5% people in the world, 90% of those people don't understand what I explained to you. The day this becomes 10, 15%, Bitcoin is going to be, when Michael Saylor says $1 million Bitcoin or Kathy Woods, this is the time when people will understand utility. Similarly, if you remember, you can go back and ask your dad 50 years back, probably people didn't understand what a stock represents. In India, we used to call the Indian stock market as Satta Bazaar. Satta Bazaar means gambling markets.
I hear this all the time with crypto, that people say, well, it's mostly based on speculation right now. We've had this conversation as well. Even though many of these crypto projects have ambitions to become adopted, the majority of them really have very little adoption. So then my question then becomes, well, then aren't you just investing in some white paper of some sort of desire, but actually there's no execution involved?
So I am definitely investing in early stage companies. The difference between an equity market is, when you come up with an idea, you go to your mama papa and scam them out of $500,000, then do a series A, then do a series B, and 10 years later you list on an exchange, and that's where liquidity comes. In crypto, it's a different thing. It's the same seed stage company with no users, but you get liquidity faster because you list your tokens up. So yes, adoption doesn't exist, but that is what the next 5-10 years will be for these companies. Today, Aave is not a speculative company. Aave has $60 billion in deposits. And when I say what is $60 billion, in India, we have ICICI Bank with $180 billion of deposits, valued at $120 billion. Aave with $60 billion is valued at what, $1 or $2 billion. So the point is, there are these companies which are building up adoption. See, Ripple in the end is a technology company that says that I can handle 1 million transactions per second. So there is some underlying value to it, right? So a lot of these companies are forming up. A lot of these companies will have value. Identity is definitely a play. Lending, borrowing is definitely a place. Real world assets is a play. So I don't know if you've been hearing this, everyone saying I'm building a real world asset thing, Tokenize, US Treasury tokenization is known as Tether. This is the easiest case of tokenization. Suppose there's a building in Dubai, you have Pripco. They say we tokenize a building so that a person who has only $1,000 can invest and buy that real world asset. So there are real use cases happening. Is it there? We are too early still. We just started 10 years back. Come on, equity markets have been there for hundreds of years.
We've started longer than 10 years back. It's been 20 years now.
First ICO started happening in 2016-17, if I remember correctly. We can compare.
First ICOs, yes. But is that when the investors came online, really? But before that, people were still buying Bitcoin and Ethereum.
I think Bitcoin was the predominant asset class. The 17 was when majority of the ICOs came. I'm just forgetting when Ethereum ICO was done, but it was around that time. So that is where, real venture investing started in this space. So it's not been there for 20 years. Bitcoin has been. And it has its own curve. It started slow and then it went on a rapid thing. And that's where comparisons also count. I always get this question that, oh, come on, Google is worth $4 trillion. You're comparing Google with the token Sui, which launched 2 years back. What sort of a comparison is this? Google has been there for 30 years. You're comparing Miston Labs, which just started 2 years back. It's not an apple-to-apple comparison. You have to give them that time. Of course, they have to deliver. In the end, whenever you're doing seed stage investing, there are 2-3 critical parameters that can fail. Adoption. Will people actually end up using this thing? Stable coins have been adopted. I don't need to prove to anyone. Bitcoin has been adopted. That's why BlackRock is there. The second thing is founder delivery. In then, our biggest problem with Web3 is, in equity markets, when you do a seed round or when you do a Series A, you get liquidity 8 years later when you do an IPO. In crypto, the biggest issue is you raise money right now, launch a token in 6 months, and your tokens are liquid. You end up having 5 million in your pocket as a founder. What motivates you to build this into $1 billion company? And that's where you see a lot of founders doing one project this cycle and making 30 million and then doing a second project 2 years later. I don't want to name anyone, but you can Google it up. So, but there are people like Ripple, people in Ripple, people in Ethereum who continue building this up. They are not bothered about the money that they made. They're bothered about the vision of building a multi-billion-dollar company.
So you're you're bullish. You're bullish on this.
Super bullish.
And you think that it's still at an embryonic stage?
Very early stage. I think anyone entering this space should not look at just money. Money any kid will make. People made millions even on Axie Infinity into 20. I think money everyone will make. What you have to understand is what position or what do you build in this space? In 10 years later, if I am right and if this industry is which is more like an equity market, more mature equity market, are you Sequo? Are you SoftBank? Do you hold the power center? Today, who holds the power center? Binance, right? Are you someone similar to Binance at that time? Are you someone similar to Sequo at that time? Are you someone similar to Ripple at that time? Because if you are that guy who just has $10 million, do you think in equity markets, if you have $10 million, you can actually move any needle? No, right? So I think this is the emerging market which people need to understand. People need to put energy and time to understand. And 10 years later, again, I can be wrong as well, but mostly I'm not. You should be in a good space because you will build a multi-generational company.
So when you say you want to become the Sequoia of the crypto world, paint me a picture of that. In 5 years' time, or 7 years, you tell me when, what would that look like to you? What are the signals I'd be looking for to be like, oh, Vineet did it?
10 years, I would say 10 years from now, I should have enough capital to back $1 billion into a company.
Back $1 billion into a company.
See, if you have to build mass adoption, Uber didn't raise $2 million like a Web3 startup and they raised billions of dollars. They spent billions of dollars to get into China, fail and come out. Please understand, to build mass adoption, cost of user acquisition can be anything from $100 to $200 sometimes. So to get 10 million actual users on board, you need money. So point is, real Web3 venture will happen when you have that much money to back companies. This was a Tiger Global strategy in India where they would say, we will put so much money that they will kill everybody and become the market leader. So that is what I would say would be successful. I call it the right to first know. So on exchanges, if someone has to land on an exchange, the first right to know is with Binance. That is known as being that guy who has done it. So I would say in venture capital, we should be that guy. People should look at getting us on the cap table. We should have enough money to put money so that they can build up adoption. Today I would prefer one of my stablecoin companies to go across Africa and build up local stablecoins or roll out infrastructure. But for that, you don't need $2-3 million will not even get you the plane ticket to go there. You need $50-100 million.
So tell me, because there are a lot of people in the space that have said, 98, 99% of the projects that you see out there now will be dead in a year or two. And I know in the 2000s, early 2000s, when we had that, internet bubble as well, it was very similar, but there were a few survivors. How are you identifying the real, projects over hype? Okay,
so in a startup, a regular number which anyone can Google is 95% startups fail. That is a known figure, not whether adoption doesn't come, whether founder is not qualified enough, whether capital is not rich. So the numbers are not different. When people say 95 to 98% projects will fail, they will definitely fail. But the standards of investing, because you're investing in a founder-led company, is the same. Is the founder having the capability and capacity to build a great company? What capability means, has he driven a car that he will make a superstar car, or he cannot make a rocket if he doesn't even know anything about aerospace. So he should have the capability to do that. He should have the capacity to do that. Please understand, I've been a startup founder for years. Doing a startup is a 24/7 job. You cannot have your weekends and still build a startup. I'm come from that thought process. Elon Musk also says the same thing. So he should have the capability and capacity to do it. The idea should make some sense. When you're building up a smart contract that will get tokenized real estate is a valid idea. Planting a tree in Africa and raising $100 million to make is not really a blockchain idea.
Has anyone tried to do that?
Yeah, people have. I get such amazing ideas,
Interesting.
I get such millionaire ideas every 2 days on my LinkedIn inbox. The third thing is, do they have the capital? See, coming to the point you said, there's no adoption. That adoption means there's no real revenue per se. Not true in all cases. Uniswap has revenue, Pump.Fund has revenue. A lot of them have revenue. But assume these are seed stage companies and don't have revenue. So they should have enough runway. That means they should have raised $10 million. Their annual expenses should be $2 million so that they have 5 years of runway. In 5 years, hopefully their product gets a product market fit and they become big. So I evaluate these 2-3 criteria very cool. Founder, very critical to have. And again, same thing as equity investment, not a single founder, because what happens, single founder on the road, accident and my money gone. So multiple founders knowing each other for time. Idea has to make sense. Adoption has to come. Adoption metrics is amazing, 15 years back when I used to be a startup founder, there were 2 different criteria. Whether he's a Facebook and he's having 100 million users joining up, no revenue, or he's a revenue-driven startup. So we should look at those metrics and invest. Be ready for 90% failure. Those 10%, like I gave you an example. We invested in 120 projects in Cypher Capital, for example. One of them was a $5 million check in Miston Labs, which came up with Sui. 30 cents was what we invested in, went to 580. Whole fund came from there. So as venture capital, you cannot have 100 out of 100 successes. You will have 5 to 10% successes, which will give you a return of close to 21% plus IRR per year, which is great.
So give me an example. When you were running Cypher, that was from 2021 to 2024?
So the first fund of Cypher was known as Phoenix VC. I ran it from October 2020 when I got a small $10 million check to 1.5 years later. And then 2 years later, I was given another $100 million to deploy. Deployed 80 million across 130 plus venture projects, Bitcoin, mining, and liquid tokens. Yes.
And out of those 130, how many were break even or successful?
I would say 5 to 10%, and I remember the names at the back of my mind. We had Solana, which we bought at the foundation on a liquid strategy deal. We had Ton, which we bought from the foundation. We had Sui. We had Sei. We had Miston Labs. We had Peak Network. Peak was one of the outliers, 70x on start. I think we had MYX as well. So, there were 5 to 10% projects which really gave good returns. But they gave so much returns that you don't really need anyone else to perform. But again, can you have 100 out of 100 successes? Unfortunately, no. But if you do a 4 to 6x in 3 to 5 years, it's not bad returns.
Let me also ask you, because something that makes Web3 founders and startup projects different from the traditional venture capital space is that they do have this option for an ICO. And it seems this is the way that most of them have been raising this. I don't think many of them do go to VCs to get backed, although I think that might be changing. What are founders thinking in terms of, should I go ICO or should I go through a VC or a fund route? What's the pros and cons of each?
Okay, so 2017 was more of a ICO model where you would just go out in public and raise. ICO is nothing but crowdfunding. Mm-hmm. In today's case, it is also similar, but it has a layer added to it. So what happens is you decide to launch a new project. You will do a private round A, private round B, seed round A, where you are going to raise money from either individuals or venture capitalists. Pantera invests in such projects, Spartan invests. There are a set of VCs who invest in that. So you are definitely doing the VC round. And post that VC round, because you want people to get involved, because this is a retail play and you are going to have a launch, you do a ICO. I would say token launch, ICO, or things like that. You can do it on CoinList. You can do it there are a lot of platforms to do that. Post that, you launch the token out on certain exchanges. So not that ICOs have gone away from the place. They still have been happening. Binance Launchpad is nothing but a variation of ICO as well. What I would suggest is you definitely need to get a VC on board. I'll explain reasons for that. Other than building a company. See, when you're raising this $5-10 million, what are you raising it for? One, to run the company. In the end, you need 3 years runway. Second thing is, to launch on Binance or to launch on any of these exchanges, it can cost you anywhere from $100,000 to $3 million just for the listing fee. Where are you going to get that money if you don't have that money? So it has to be a mix of both. You have to understand that your token distribution has to be critical. You cannot have 50-60% release because everyone will sell. Mm-hmm. And then you also have to, as a founder, focus on building adoption. Token launch, great, went up, went down. But your company became so big that everyone was forced to rebuy your token because they see vision in you. So for me, founder has to focus on delivering the idea that he did and not just on the token price.
So give me a picture of this, because the traditional VC landscape, I have a pretty good grasp of, particularly in the region, but also back in Silicon Valley. What does the Web3 and the crypto sort of more, if I say traditional or more structured institutional finance players like yourself look like? Are there a lot? Is it an old boys club that know each other?
So definitely there are a lot. And yes, there are people who know each other because see, it's early stage. Everyone's right now still all the bigger funds have been in equity. They know a lot of them don't invest in tokens per se because they don't understand this token model. So yes, you have A16Z, you have Pantera, you have Spartan, you have Hashed, you have Hashkey, we had Cypher, now Sigma Capital. So you have a set of these VCs who are the top VCs which invest. And then you have the smaller ones who put those 100 to 300K checks in. So yes, there are these ones. What do they look at? Again, they look at the same thing. What is the product going to deliver? Is the founding team capable enough to do it? Market conditions also play a bit of a parameter because see, in equity, you have a 10-year listing. 10 years, whatever happens inside the company is not visible to you. You probably came to know about Uber or Facebook's equity when it got listed. But inside what was happening, you never knew. In tokens, you get to know because token is launched, token goes up. It's transparent, goes up in price, goes down. So this is something that I also explain specific to token. In 8 years, you have 100 people who invested in Uber to get a return. But in that 8-10 years, there were 100 million people who sat in an Uber, and on the day of listing, 100 are selling and 100 million are buying because they know what Uber does. But in crypto, you raise money from 10 people, launch the token goes 10x and everyone sells. And there's no users to buy. But this is where Ripple becomes interesting. They went from 10 cents to $3. Token crashed because there was no utility. They said, we'll make it a Swift network. That means banks will use it for transfer. They went up to $2.2 last cycle, came down. Then again, they said, we will build a layer 1 that will handle these million transactions, and they're back on. So that pivots are happening in real time, which people can see. And if you believe in the token, you get the upside.
And for you at Cypher Capital, what's the typical check size that you're writing at the seed stage? And what's the typical round size for these projects to get off the ground?
Cypher Capital was earlier. Now it's Sigma Capital.
Sorry, Sigma Capital.
At Sigma Capital, we normally would do anywhere from $500,000 to $2 million in the venture side of deals. This is tokens which are not launched. I also have an active liquid strategy where we would be investing in top 100 tokens like we did in the last fund as well. This will be $2 to $5 million of investment in tokens at a considerable discount to the market prices. Locked tokens taken from the foundations.
And so if I were to come to you and I said, I'm the latest and greatest Web3 developer and I've got this amazing project, typically, how much am I asking for that 2-3 year runway?
See, again, it depends on what sort of a team you have built. You know, when you talk about Miston Labs was raising $300 million in a bear market and raised $450 million. Please understand the difference between Sui. For you, Sui is a name. For me, what is Sui? The founder of Sui was the head of technology for Facebook. Zuckerberg had hired him up. Even Cheng and Costas were hired by Zuckerberg. They had the technology which was Libra. Libra was the blockchain of Facebook. And they had the $300 million. So it would depend on the project capability. Some projects only need $2-3 million at a $15 million valuation. And some projects are at such a big scale that they need $50-100 million. So I would ideally do early stages. Early stages would mean something like a $20 to $50 million valuation.
Okay.
$500,000 to $2 million checks me. And of course, their fund size, I have to understand their runway. I have to understand what they're trying to do when they're going to launch. Because looking ahead, I see a bear market, so people have to have 2-3 years runway. So, with my $500,000, they should have $2-3 million of other commits, and I would invest in them. And of course, you also have later stage deals. Someone who has raised 2 rounds and you're deploying there. You're not looking for 100x's in your investment. You're looking for 4-5x on your investment, which is not bad as well, right?
Yeah. So let me ask you, before we get into, some advice you might have for Web3 founders on how to go about this fundraising process, I want to ask you, because you've been through some interesting cycles. In the traditional VC world, we've gone through a bit of a winter as well. The crypto world has gone through several winters in the last 5, 6, 7 years, I would say. But also there's been this maybe a catastrophic era for crypto. And I'm specifically talking about Luna and FTX. I'm curious if these events have changed investor behavior over the last few years. I know that both of those catastrophes happened in 2022. Has it changed the way that you approach investments and look at the sector?
See, some of these events which you mentioned are black swan events. So there are structural events and systemic events. See, Luna, what went wrong with Luna was Luna had a stable coin that was a algorithmic stable coin, which got depegged because someone went behind them. Luna had $3-4 billion in treasury, which someone went behind that we need to depeg the coin and remove that 4 million from them. And people do that. They did that. Someone did it on the British pound as well years back. He's known to be legendary. So someone said, okay, Luna has 4 billion. Let's go behind it. This is the system goes, this is a structural issue. We had this structural issue on 10th October when one of the stable coins depegged on Binance. Then you have the systemic issues. Now what happens is, okay, suddenly the markets collapsed 80%. People like FTX who were in there investing across plays suddenly have a liquidity crunch. So when, this is a very controversial one, but when FTX collapsed, other than all the fraud that it did that I don't want to go in, I clearly saw that all his investments were worth more than $100 billion. And I sort of have quoted this 3 years back. Today you see the same thing. The only problem with that gentleman was... You
mean FTX, what he was building, was worth $100 billion?
More than that. All his investments are big. So he had investments in Sui. He had... See, this is the kid not having risk management. Please understand. what he did was, see, he did wrong. I don't want to commit on he took money from the exchange to invest in projects, which is wrong. But what he invested in was worth valuable. So that's why people have to understand between assets and liquidity. He might be worth $90 billion, but all those tokens are locked. He needed to have $4 billion in liquidity. Why does Warren Buffett have $230 billion or whatever in cash? Because that liquidity saves you when market downturns happen. So in his case, he had all great investments. People were vying to buy those investments because he had to sell. He had no option. At that time, had he gone and somewhere raised $5 billion, he would be worth $200 billion right now. And you can Google this up. Twitter, there are enough Excel sheets of his investments and see the value of those investments.
Interesting.
So, this has happened this time as well. You had the, the stablecoin DPEG. And if this market remains down for another 3-4 months, if Bitcoin goes to 50,000, miners will get illiquid. In a lot of these tokens will get illiquid. You already have started seeing layoffs happening. And whenever you run out of runway, companies will fall, and companies falling means tokens crashing. And hopefully we don't have a global macro condition because inflation is going up and stuff. Hopefully, because if funding freeze sees to it that companies can die.
But as I'm hearing you, it sounds like you are assuming or hypothesizing that we're about to enter a deep bear market, another crypto winter, perhaps, or am I misreading you?
So we were discussing this on 10th October. I had this chat that, when Bitcoin was at 126K, I said that it's going to drop 70%. It's already come 40-50% down. I think the bottom needs to be found. People are saying the bottom was found. Again, I don't have a magic ball. Nobody in the world has a magic ball. I think the global macro doesn't suggest that the bottom has come.
You think it's going to fall even farther?
I think so. I'll explain. Suppose tomorrow, you're based in Dubai, you're seeing market conditions here. Suppose there's a job layoff. Suppose, stock markets go back and you need money to sustain. Will you sell your house? Will you sell your gold, or will you sell your Bitcoin? You as a person.
If I had Bitcoin, I'd sell the Bitcoin.
Because you don't understand this asset class. And this is where,
I agree with you.
And that's 90% of the world.
I wouldn't sell my house. What was the other option?
Gold.
I mean, if I had gold, I suppose I'd sell gold. Yeah. I would sell them equally.
See, a lot of these people who entered into Bitcoin just entered because it will go up in price. They never understood the utility that we discussed. They don't understand Ethereum is a smart contract platform. So this is the risk that I carry. If the global stock markets collapse as in like you have 10% down, 15% down, people will start this asset class just to cover their losses over there.
Yes.
And that is where the buy opportunities will come again. I don't want to be the
buy guy. But okay, you were saying there's an opportunity potentially to come, but you are also saying the vast majority of retail investors in Bitcoin don't fully understand what it is that they're investing in. And when things get really hard around the world, people will sell.
They will sell. When you don't understand an asset class, you sell it. And my experience comes from the last 1 year on being on the road, meeting people. I ask them, what does Ethereum do? Tomorrow, do this as an activity when you meet 10 people, ask them what Ethereum does. You will be shocked to see that nobody understands. And these 10,000 coins, they think it's all magic coins. There's no utility there.
But even if they understood that Ethereum was this layer 1 blockchain that had this smart contract system, again, we come back to this point. This is where I go, okay, fascinating, great technology. But again, they've been around for a really long time. And there's been this real question of how efficient is that system for it to be widely adopted.
See, again, they have been here for 8-9 years. If you're going to compare it with Google, it's not fair. Google has been in there for years.
No, but let's compare it to Amazon. Amazon became profitable after 11 years. Yeah. But they had to build all of those processes and systems. And, I don't know anyone at Ethereum. I'm not picking on them per se, but just because they were one of the biggest names from the very beginning, I really, as a skeptic, I told you before we sat down, I am a bit of a skeptic of this world. It does feel like a lot of speculation. Some of it feels very visionary, and it would be really beautiful if I could fully understand. But obviously, I can't comprehend when I don't see a real adoption or utilitarian value in anything that's come out of the space.
Yes. Today, when you go home and, if you have the CoinGecko app on you, go to Ethereum. Under there's a revenue tab under Ethereum. And you will see, I think they have $1.5 million or something like that in real revenue every day, trading fee in the fee. Because every time you send USDT on Ethereum, you have to pay gas fee, right?
Right.
Every transaction. So they have that money. Pump.fund has $800 million in revenue. The Perp exchange, which I'm forgetting the name, Hyperliquid, has $800 million. So it's not that they don't have revenue. All of them have revenue. It's just people don't understand.
Is anyone profitable?
Pump.fund and this, they don't have any burn rate. So they are more or less. Binance is profitable, super profitable. And see, he has two things: profitable in cash flow and profitable in assets. Because, when you list on Binance, you have to give them equity tokens. They hold that tokens. Those tokens, the last presentation I saw of Binance 3 years back was crazy amounts,
I know that Binance is, but I also don't really hold them into the same category because they are, the fintech rails and in order to allow sort of retail players to trade, right? And so they're providing that as a service. So I see utilitarian use there. I don't see adoption anywhere else.
So Binance should be considered as a stock exchange. They do $1 billion of transactions. Yeah. Stable USD, Tether is doing an IPO right now. I think a $1 trillion IPO. You should see that as a use case. Ripple is one of the companies which is building up strongly. There are companies that you have to look at it. But for me as a venture capital, though I'm looking at the top ones, Solana, today if you look at Solana, the number of active wallets and the number of users on board is phenomenal, much bigger than anything else in the world. Whether they're there to buy Pump.fun meme coins or whether they're there to do anything else, I don't want to go there. But they have real adoption. So these companies have adoption, these companies have revenue, and they're growing. What they really need to do is, and which I've been talking at a lot of places, they have to step out from their crypto bro community and get real people on board.
Real people. Tell me about real people. What does that mean to you?
I would say real people on board means someone land up in Africa and see to it that a stable coin system is built over there in consultation. Like Google has people who talk to governments. How many of these crypto companies have people who talk to governments? I haven't seen any one of them, other than Coinbase probably. So we have to do that. We have these a lot of mines are there in Africa. We can tokenize those mines. People can get access to capital. Identity is a problem. Cardano went to Ethiopia and said we will digitize the identity of all the school students so that their identity, that their education degrees can be put on chain. We can verify it. We have to get these real products on board, which can generate real revenue across. So not just, promoting yourself in Singapore and New York at events, having parties, but getting real people who are not speculating on your tokens, but using your tokens to do something. And I think that will happen in the next 5-6 years.
I hope so. I hope so. That's what I want to see. Because I have heard you even say, I'm going to quote, you said that some founders raise huge amounts of money but have no idea on how to build a real company. So I want to ask you, what are the dead giveaways in the first meeting of filtering out who can build really a real company here and execute, which sounds like it's not that common in this space. And those that we see a lot of who might be tooting their own horn, but not doing a whole lot.
See, a lot, because for me, this is different because, I have been a startup founder and I have been an internet founder. I did companies that used to sell online. So whenever a founder comes and says, I will have 10 million users on day 2, and I have to ask them, how are you going to acquire those customers? If they have no clue of cost of user acquisition and lifetime value of customer, today people go on Twitter and get 200,000 followers. I used to do that as a kid. I used to trend on Twitter and do stuff like that. Getting 200,000 people on Twitter doesn't mean you are going to get any revenue from there. So when people talk about those metrics, I had a founder who said, we have gotten this big grant from one of these layer ones and I have 30,000 people on my website. So I said, can I open your Google Analytics? 30 seconds of a view. Basically bots running it out. So when you look at those numbers, a person like I'll give you an example in one of the companies that I invest. I should not be shilling, but we talk about a company known as Accurist. Accurist was invested by Gavin Wood. Gavin Wood was one of the Ethereum founders and Polkadot founder. Now, what this guy did was, all these dead phones that land up in Africa landfills, he says they have these compute chips. So basically, he told people to connect these compute chips so you can have a decentralized compute network. Not the phones you work on, the phones which are dead, lying in landfills. This sees to it that you can earn money because your compute power is plugged into the global compute. Is it not a GPU compute network? No, it is a lower edition where you can test your apps. You don't need to go to AWS to host everything. You can do it on the cheaper ones. Now, in this case, you have the users who are in Africa getting money because they can put up an infrastructure play. Here you have a founder that has built something, he has, I think, 250,000 phones already on the system. And they're growing pretty slow. They're not, they don't have a dream of we'll have a Ferrari tomorrow. They want to build up a data center which will have probably 100 gigawatt worth of compute tomorrow. So you look at those things. You look at founder motivation. Always meet a founder 2-3 times. You need to know that the motivation is not just to raise money. So certain parameters, meet them again and again, understand their motivations, and then invest.
What makes you instantly lean forward in a pitch? Can you think of one recently where you were very intrigued?
So, again, I don't take a decision on day one. I take a decision because, see, our biggest risk is founder motivation.
It is the biggest risk.
It's like...
because are you saying that in the Web3 space, it's actually a lot longer pathway than, let's say, more traditional tech companies?
So as a rule, I always have this thing that you should meet people 2-3 times before deciding. And I do that usually.
I mean, I think every investor does that anyway, right? Well, I think they should.
They should.
Yeah. But I'm curious, do you believe that runway for a Web3 tech startup to become successful is technically most likely longer than a Web2 tech founder?
Because adoption is slow. So they definitely need runway and their product should have real value.
They have to be marathon runners and visionaries.
And the token has to have real tied utility. A lot of people, I ask them, what does your token do? And it's not tied to the process. They say it will earn 8% staking yield. That's not utility. I can put it in USDT and earn. And your token is variable. I have no clue on it. So I think the runway is longer. They have to have enough money so that they can build adoption. In the end, they can end up becoming a $4 trillion company as well. So for me, founder perseverance has to be checked as well.
So for all of the Web3 founders out there that's looking at you and going, gosh, we would love to have Vineet back us. I think he's the real deal. What do they have to have prepared before they meet you where you say, if you don't have these things in place, then it's not worth the time?
Some traction numbers. Again, I get thousands of messages and we have these funny comments on LinkedIn always. People send LinkedIn messages. Come on, I was a founder. I was always told you need to have a warm introduction. If you cannot even get a warm introduction, you want me to invest out of the blue, doesn't happen. So probably first it starts with a warm introduction. You have to come with your numbers. You have to meet with the team 2-3 times. You have to explain how you're going to scale this up. What money are you looking at? What do you call runway do you have? Now, because this is a token element, please understand equity and token doesn't run the same space. And if remember in equity, we used to say one founder should build the company and one founder should raise the money. Similarly, in this case, one founder should build the company and one founder should know how to launch a token. Two different things. So, when you talk to a founder and you understand, he can be a failed founder. Failed founders are amazing people. I love them. I am also a failed founder from my last startup. So, point is, you look at motivation, you look at energy, and that's what, I continue the discussion. And Accurist, I invested after 3 calls and, then I doubled down on those investments. Some of these ones, you meet 3-4 times and just invest because you know that these guys are going to stick. And this can happen in 10 days. This can happen in 6 months.
Very interesting. Now, if you're on that 3rd call and you're like, okay, I think I'm going to invest. Take me behind the curtains at Sigma Capital. What happens in the next 72 hours or several weeks? I don't know how long that process takes for you to, get to that point where you go, okay, we're going to deploy with these guys.
Okay. So in the past ones, it was a single guy giving me money. So, I like the project. Money is wired tomorrow. Now, this is not a regulated venture fund story.
Right.
Because people don't invest only on your performance. People invest in your process. In Sigma Capital, what happens is when we meet a founder, one of my co-partners does a lot of due diligence, what the founder background, what are they doing, the whole nitty-gritty of it.
How long does that take?
A week to 10 days.
Okay.
After that, if they are a go-ahead, and we have to also look at market conditions. You don't want to be in a bear market, the first check in and they don't end up raising money. So a lot of those parameters. After that, you have to do an investment committee analysis because it's a regulated fund. I have 5-people board which decides whether this investment is worth it or not. Mostly,
and they're all LPs of yours?
they are GPs to the fund, well, advisors and GPs to the fund. Like I have known names in this space. Like 2 are from the fund and 2 are from outside. So out of that, I have an extra vote. We look at that. We do a risk committee that, is this person, the whole background of the KYC and stuff like that. Because it's regulated. That's why there are these processes. And over that, it lands up at admin and the money gets sent out. Because it's a process-driven regulated fund. If it was just like Cypher Capital, we would have done our analysis and send the money, because we don't have to answer anyone there. But here you have LPs you have to answer to.
Now you have a lot of people you have to answer to. And so this whole process from start to finish, if it's smooth sailing, what's the shortest time? And then what's the longest time you've taken?
I think we closed the fund in August and we did 5 investments in less than a month and a half.
Oh, wow. Okay. So all of this that you've just explained can happen in just a few weeks.
Yes. 2 of those projects are already on Binance. So it is easy, because and there's a lot of work behind them. You meet 100 projects and then you come up with 5 projects. I'm looking at one project right now. Hopefully I invest. RWA Play, $80 million in deposits, raised $10-12 million already. Founder has been on it for 3-4 years. So what I'm trying to say is, yes, there's a lot of back work where you have met the founder, but once you have decided that this is some space that we are going, a month is maximum that you invest in. Money gets sent to your bank account.
Interesting. Very interesting. Okay. Tell me a little bit about some of the pet peeves you have of founders that you've already mentioned, like cold outreach on LinkedIn, whatnot. What about within the pitch when they're speaking to you? What's something that you've noticed in this space that you're like, this is just something that shuts down the meeting for me?
So one of the things that I have seen it again and again, and this happens again, because sometimes you have kiddish founders. This is this opportunity that will make you a millionaire. Come on, man. Make yourself a millionaire first and then make me a millionaire. See, money cannot be the motivation to building a company. I'm not building, we had this chat right now. Did I tell you in that whole conversation that I'm building Sigma Capital for the money? Money I will make. I don't have confusion. We said we are building a company that will have the right to first know. Do you think CZ gets excited with the $90 billion? He's the guy who gets known in this industry. Michael Saylor, do you think it's more money motivates them? So people should be motivated by building a company that will add value to the world. So I want to see that. If you're going to talk money, not interested, name dropping, I know this guy, I know that guy. For me, that becomes a bit funny sometimes. If you know everyone, why are you sitting here? So this is another part. Not having idea on metrics. This is something that fully switches me off. I'm a founder. I always have known what my numbers are. I don't have to open up a laptop. I give this as an example to a lot of my people I train. When you go to a shop in India and you ask for a detergent, he doesn't open a computer to find where the detergent is. He just pulls his hand and gives you he knows his business model. If you need to look at your numbers on a computer, you don't know your model. I'm not, the point is about being sure what you are doing and being confident. I never present to people. When we were raising capital, I would talk like this and I would send the presentation on email. I don't need the presentation to help me answer my business.
Interesting. Very good feedback there. Let's come back a little bit to tokenomics. If a founder was building something that could exist either as a token or a pure equity company, how should they decide which path to take?
If the token is connected to the process, definitely a token, and it is another way of raising capital. If there's no utility of the token, if you're going to build WorldCoin and tokens are not going to pay for the identity scans, if you're going, like in Fortnite, you have the V-Bucks, which basically run the economy. If there's no use case of token and you're just a vanity product to raise money, not worth it. Because see, please understand, why does token fall in price? Because no one holds it. If you make a person hold because it has real utility, it will go up in price.
Okay, let's dig a little bit deeper there. So if, I think there's a lot of Web3 founders out there that say we have a great tokenomics. What are the real sort of KPIs that you're looking at to see that their tokens have high utility?
Okay, so tokenomics is nothing to do with holding of tokens. Tokenomics is the distribution schedule of the token. What it means is Earlier stages of the token launch, you need less supply to be there so that, you can build up distribution and token can go up in price. Your treasury goes up in price. So that is the token part. There's this low float, high valuation model that has been going around. What it does is markets, once they go bullish, you end up having good treasury to run a company for years. But what is important more than tokenomics is token utility. I have your token. Your game is becoming crazy. And the token is going to run the game, and it has suddenly gotten 200 million downloads. I know people want the token tomorrow to buy the skin. I'm holding to my token. I'm not going to sell. And I'm going to sell when it reaches 500 million because I make a lot of value. So people don't think about that. Like, I'll give you a real example. Binance token. If you own $1 million of BNB token, Binance Launchpad, if you just take that token, you get the new project in your hand. That new project, which you're getting free, right? Because you have just staked your BNB, can give you, on $1 million, can easily make you $100,000. This is real utility. Like suppose they launch alt layer on the token and you have staked $1 million. You might get $50,000, $100,000 of alt layer or whatever. I don't know the exact number. So there is utility. For me, motivation to either buy or to hold the token because the next launch I get token. So this is one case. There are multiple cases. Games, you have to have tokens to it. Ethereum is a superstar utility play. Please understand, a lot of people, we always talk about people, Ethereum $2,000, $3,000. Every smart contract that is built on Ethereum, whether you have to sell USDT, whether you have to do anything, you need Ethereum. Whether it is $2, $5. So Ethereum is a utility-driven product. And here you need to understand, founders need to understand two things. There's need and want. You need water and food to survive. You need Ethereum BNB because they make you value. And then there's a want-driven thing. You want a Ferrari. Ferrari doesn't come, you don't die. A lot of these tokens are want token. Come to my platform and you can buy 20% discount. I can buy it on Amazon. There's no need for your token.
So I can see that. If that's true, and that was always the case for Ethereum, what is stopping adoption, widespread adoption of, smart contracts?
See, adoption, it's not that it's not gone adoption. How do you define adoption? By number of users or by price of Ethereum? First define me that. I need to understand.
I would say, well, for me, it would be, I look at it from like a pure technology perspective and how well smart contracts are being utilized, right? And so that utilitarian factor, it's not necessarily how many customers, but I guess it's more integration into society, how we're running the world, how we're running banks, how we're running insurance, logistics, et cetera. And I got the impression 10 years ago that it was on the up and up. And now it doesn't seem like, there's been that much change as what we were expecting.
Okay. So you know that as of now, stable coins are worth $200 billion, right? Or $300 billion, something like that.
I didn't know that, but okay.
Yeah. They're expecting it to be $1 trillion of value, $1 trillion stable coin, and the value is going to be crazy. Where are they running? They're running on Tron, they're running on Ethereum, they're running on Solana. So it's not that adoption is not going. Adoption is happening already.
Is it because, a couple of years ago, there was also this issue of Ethereum costing too much?
Gas fee.
Gas fees and whatnot. And I assume that's why one of the reasons why Solana has done so well. And is it also because Solana and a number of other competitors have emerged that might have a stronger technology?
There's a stronger technology. There's a adoption case. See, in the end, for your technology to become really good, you need to have those killer apps. Ethereum has Aave, Solana has Pump.firm, Solana has Hyperliquid. Each of them have. Arbitrum had GMX. Sui, I haven't there was one big investor who asked me, should I invest in this layer one? I said, have you used any app over there? You personally, have you invested, have you used Solana? See, I have used Solana. I have seen use cases. I've seen adoption cases. Ethereum I've used. So yes, there is adoption coming through, and sometimes this adoption is not seen by you. When you are sending a stable coin, when you're going to your money exchange and sending money to Canada, example, I want to say, maybe they're using a stable coin rail and which is flowing out on Sui. It's just that you don't have visibility.
That's not visible to me. So there is things going on in the background.
On the Sui, you haven't seen that crazy hyperbolic on adoption, but it is coming.
Okay, fair. As I sit at this table, I often ask investors about founder transparency, how important that is. So I'm curious, from your side of the table, what's the one thing founders should never try to hide from a VC or an investor that's backed them?
So again, I think their background is critical, whether they have failed or not. Failing a startup is not a problem. I have failed a startup as well. What have you learned from there is very critical. Founders can be two types. They failed and they want to end up making a big startup. I think Sandeep from Polygon failed in 3-4 startups, ended up doing a Polygon, which is big per se. So failing is never a problem. Hiding your failures is a problem. And after failing, what have you learned is a problem. Because two types of founders. Founders who failed and want to become something big, and founders who failed and have got burnt out. For them, everything in the world is negative. So I keep away from those founders. But you shouldn't hide your failures from a founder. You shouldn't over commit. I will make 200 million subscribers, 300 million subscribers, 500, and you have no idea on how to get even first 10,000 is very critical. Founder relationships have to be clear as well. If you know the person, how well do you know, all of those clarity point, because we will find out. In the end, due diligence will figure out how you know a person and how much you have worked from it. Fudging any of that data is pretty risky.
And what about after you've signed on and when they're calling you and, is there a relationship where you're really involved in the business where they come in, you can advise them on things that are going on?
So in my case, I'm more of an investor and not an accelerator. Accelerator is more when it's early stage and you need a lot of hand holding. I'm more of an investor, put money. If they need any help, happy to help. They can need help in getting to other investors. They can need help in getting to exchanges. They can need help in QLs. For me, I have moved away from just this crypto pro part to, maybe they need to go into Africa and sign up with some governments. Maybe they need to get the Airtel or any of these mobile providers to get relationships. So I'm happy to help in all of those. Maybe they need to connect to other founders. So yes, I do that. But I'm not a founder. They have to ask me for that help. I cannot go and impose myself. So yes, I do support them, but I'm not pure play accelerator where I will handhold them all the way.
That's also, it's a fine line, right? On one hand, a lot of players want strategic capital that can really help them, that they can bounce ideas off of. But on the other hand, they don't want the investor to be super involved. There's too many, cooks in the kitchen, they would say. And so it is a fine balance to try and figure out what that right balance is. But it sounds like you are very much more of once we decide, we let you do what you need. And if you need help, you got to come and ask for it.
You have to ask for help and we will connect. If I can connect, happy to connect all across. But I cannot drive your business. That is, we're not that early stage investor. We're more of a place where the founder is already. And I said founder has, if my capability and capacity evaluation is wrong, then I'm at fault. But if I know, I'll give you an example. I invested in this token company which is building up a stable coin play. The founder was was in Goldman Sachs for 10-15 years and was the Winklevoss Twins exchange, Gemini. He was the managing director for Southeast Asia. Capacity wise, he's already big, right? He has $200 million in stablecoin US Treasury deposits. What I can do with him is if he needs a connect with a family office, happy to connect them. But I cannot advise on him because he's more experienced than me in this space.
It's been an absolute lovely conversation. How I want to end this is to ask you, you've been here longer than I have. I've been here 16 years. You've been here since the early 2000s, I think, here in Dubai.
23 years, 2003.
2003. Yeah. What is that?
3 years.
23 years.
Yes.
I want to ask you what you're seeing in the Web3 space. Everyone talks about Dubai being the new capital for Web3, blockchain, crypto, et cetera, et cetera. Give us a little bit of a view of your view of how you've seen this come about, why that's important, and why it's important that Sigma Capital is here.
So see, something that, whoever is hearing this podcast in the world, people have to understand, now with this Iran conflict that is happening around and people are saying Dubai is gone and Middle East is gone. I've been here 23 years. I've seen this COVID came and this came. The most amazing thing about this country is that they don't take time to evolve. When COVID came, they quickly got everyone vaccinated. The city opened up. In 90s, they came up with a duty-free ban. If you remember, the Marlboro duty-free bags were floating around. I think when I came 23 years back, they opened up real estate. So they are always ready for innovation. So I think New York Times had this like, never bet against Dubai. So what I would tell people is, yeah, there's a plus and a minus. People say security. It will rise back. This is the place which connects you to the markets of Africa and India, even Middle East. This is the place where capital is there, whether it is into Saudi, whether it is UAE, capital exists over there. This is the right time to be here because see what has happened. Whenever bull run goes off or whenever things go down, the bling people run away. And this is the time when you get to meet people. I think this place has scope. They will keep on building. They will keep on innovating. Crypto for sure. I think they have their whole niche. Today everyone says US and Singapore. Yes, but these guys have real clear regulation clarity. You can set up companies, you can build it up. All the major events happen over there. All the people who have built in this space are present over there. So
I think some have argued that the US regulatory clampdown on Web3 has actually helped build up Dubai.
Now, this is what I say might be controversial. See, I come from India. India is a democracy. The problem with democracy is that it can change in 5 years.
Yeah, right.
So I shouldn't be saying, some of these are very controversial views. So what happens after midterm, nobody knows. But with Dubai, see, this is one of those, I think they call it benevolent dictatorship or something. Like Singapore had the people looking at the same direction to make this country amazing. And that is what's happened with Dubai. They have made, when you look at the infrastructure, when you look at the policies, when you look at the support, everything is amazing. Just like Singapore.
It is. Very
and that's
similar.
What makes it amazing. Anyone can come over here, peacefully do stuff over there. I can walk on the road at 4 o'clock. I can work at 3 o'clock till 3 o'clock in the morning and life goes on. No one comes and troubles you. And you have a lot of founders here who are building out of here. You have a lot of investors who are staying here because they think Dubai is safe. And that's the place that you need to have events where you meet people and continue building.
Love it. Vineet, thank you so much for your time. It's been an incredibly fast 1 hour.
Thank you for inviting me, Eric, and great chatting with you as well. Thank you.
Thank you.
Hope to see you back in crypto. Huh?
We'll see.
Sure. Thank you.
Hey there. Thanks for joining this conversation. If you enjoyed that episode and you want to start researching potential investors for your startup's fundraising strategy, go to lucidityinsights.com and sign up now to the startup registration package by clicking the plans button on the top right corner. We look forward to having you join our future conversations and checking out our additional content. Until next time, stay hungry and stay humble.